With most of the economic data from Q2 now in, July has been a month of introspection and reflection. It gives us a window into what has worked, what has not worked, and what to look out for as we move forward into 2020. So for my July update, I'm going to be talking about some of the success stories. I'm going to be honing in on China and Canada. I'll be talking about what has not been so encouraging, which has been the US response. And lastly, I'll be talking about the index returns as well as portfolio positioning for the rest of 2020. Greetings viewers, you are listening and watching Aman Sanga, independent financial advisor based in Mississauga, Ontario. So let's start with what can we learn from the success stories of 2020. COVID-19 started in China in early 2020, and it was an unprecedented challenge. And let me say that the Chinese government had stepped up to the challenge really well. I mean, they did introduce draconian measures which seemed really harsh for the people. And it basically all but shut down the whole economy. But if you look at the data coming from China now, whether we look at the GDP data, whether we are looking at the services PMI data, whether we are looking at the retail data, or we are looking at the stock market data. And it is a picture-perfect representation of a V-shaped recovery that has taken shape. And it just gives the picture that the underlying economic data and the market data, they are in sync, unlike the impression that we get, especially coming out of the US. Now let's come home to Canada, and I think Canada has done really well here as well. For a geographically spread out and diverse country, we are now averaging less than 500 cases a day, and the number of deaths per day has dropped within a single digit. The job market responded very nicely in the month of June, and combined with the fact that we have a very accommodative fiscal and monetary policy, the support and the coordination from the Bank of Canada and the Government of Canada, I think Q3 should really bode well for the Canadian economy. So let's move on to this discouraging news, which is the news coming out from south of the border. Now, if it just seems like a sad story, virus is totally out of control and looks like a runaway train. Now, the markets by themselves seem to be reflecting a V-shaped recovery, which you can plot along the dotted blue line on this graph. But in my mind, I think what has been overlooked has been the potential for a second lockdown, which would probably put the recovery along the dotted W shape that you see on this graph in front of you. That brings me to the last part of my update, which is the index and the asset class returns so far. Now, if you can see, the S&P has turned into the positive territory for the month of July. Now, which seems good, but a deeper dive into the returns of S&P 500, and if you look at the past 12 months, the only thing that's holding up the S&P right now is 5 stocks, and the rest of the 495 stocks are relatively flat. But there is a big winner here in this story, and that is gold. Gold has had a fabulous run since the start of 2020, and with the rates either negative or at record lows and likely to stay there going forward, I think gold is likely to continue into its pole position going into rest of 2020. And that means the low interest rates, especially in the US, put a downward pressure on the US dollar, and which does have macroeconomic implications on how your portfolios are positioned. So if you are looking for ideas of repositioning or rebalancing your portfolios in context of this new environment, you know the number to call 905-363-5035. Also, I have an announcement. I'll be starting a mid-month video series starting August. I'm keeping the topic suspense for now, but please look out for those new videos starting mid-August. Lastly, I want to conclude by saying it's been a great summer so far, at least here in the GTA. Have a great and fantastic rest of the summer. Enjoy responsibly, stay safe, and keep watching. Thank you so much. Bye for now.